Saurabh Mukherjee joins us now. Let's take our conversation forward. Saurabh, good morning. Thank you for joining us. Saurabh, I have to start with the obvious, which is that there is a shift in risk. There is a shift in interest rates. There is a shift in how central bankers are going to be approaching this high inflation terrain. If the big picture, which is a combination of macro, rate cycles, and interest rate has changed, how does that change life and investing for someone who is a proponent of buy good quality at a reasonable price and then ride the momentum? If the cycles are changing, is it time to change the portfolio orientation as well?
I mean, look, Nikunj, I've been doing this for the best part of 20 years. And one of the things I've learned is the more things change, the more they stay the same. So I think over the weekend on the Economic Times website itself, we published a piece on how through the 70s, as the oil price rose tenfold and the US 10-year bond yield went up almost non-stop for 10 years, the US stock market went nowhere, and that's well known. But the US stock market struggled through the 70s. But in the same decade, Japan, one of the world's largest oil importers, in the same decade, the Japanese stock market trebled, and well-run, efficient Japanese companies, the sort of Japanese equivalent of consistent compounders, if I may say so, well-run, efficient Japanese companies compounded in local currency terms, in yen terms at 20%, and in dollar terms, I would say closer to 25%. So 10x in 10 years. For Japan, for Japan's leading companies, Toyota, Nissan, Honda, Sony, Panasonic, JVC. Why were they able to compound even with interest rates rising, even with oil prices rising? Because they were efficient companies providing useful products to the entire planet, and hence their success. And I think the same holds true for Indian companies over the next couple of years. I agree with you that the Federal Reserve will have to hike quite aggressively. I think that Federal Reserve will have to hike far more than the current market expectation. I spent 2 weeks in America over the last month or so, and I've never seen America in this shape. They've got a serious problem with inflation, and they'll have to hike aggressively. And yes, low quality companies who don't generate cash, who survive every year through raising money, I think they really will have a challenging couple of years. All power to the companies we've invested in. They generate lots of cash. They reinvest this cash to grow their businesses at 20-25% and will carry on compounding with them.
Saurabh, the general view is that there is a P compression in high stocks. High expensive P stocks, they are going through a P compression. And that is the reason why, because risk is adjusting. If risk is adjusting, high P multiple stocks will come down. While these companies may grow, but even if a 15-20% growth, if P multiples they come down, then ultimately for shareholders, the returns will get compromised.
Right. So let's just look at this, right? So we have large shareholders, as you might know, in HDFC Bank. Marcellus is as a PMS. I'm invested heavily in Marcellus's PMS. My parents are, so I'm also a large shareholder in HDFC Bank in my personal capacity. Similarly, we are large shareholders in HDFC Life, in ICICI Lombard, in Kotak Bank. I didn't see any, big PE expansion story there in the last 2-3 years, right? I'm happy to be corrected, but many of the stocks I hold, I didn't see a big PE expansion. In our portfolio of, say, across our various PMSs, we have around 30-35 stocks. In our PMS portfolio, there'll be 10-15 stocks whose PEs went up. There'll be 10-15 stocks whose PEs went down. 10-15 whose PEs went flat. And therefore, in totality, and we look at this quite carefully, in totality across our portfolios, share prices and free cash flows moved 1 for 1. Right? Over the last 3 years, over the last 5 years, share prices and free cash flows in our portfolio moved in lockstep. And that's the way I think it is in most sensibly constructed portfolios. I don't think any sensible fund manager anywhere in the world sits and plays PE expansion. It'd be suicidal to do so. Sensible investors say, I'm going to invest in businesses whose free cash flows will grow at a healthy rate. In our case, they grow at around 20-25%. And the share prices will move in in broadly that rate. And that's what we have seen, Nikunj, over the last 2 years, 3 years, 5 years. And hence I get a little baffled when people get really caught up in this whole PE story and say, Asian Paints ka PE dekho, ab niche aayega. And I keep thinking, well, how does it matter? Finance 101 teaches us the value of a business is free cash flows discounted. If free cash flows are growing at 20-25, and that's what Asian Paints' share price is giving me, or Divi's Lab's share price is giving me, or Dr. Lal Path Labs' share price. I'm deliberately choosing the names that everybody gets worked up about. If the free cash flows are growing at a decent rate and our share price action is moving at the same rate, I'm not going to lose sleep about this whole PE story.
Saurabh, we always talk about where you got it right, but let's also talk about where you got it wrong. And I recall reading about, how you got ITC right, and I'll come to Page as well. But tell me now, as you look back, now that ITC is the performer, where do things stand as of now?
So same point, Aisha, same point. So ITC's case, we see the power of the cigarette franchise and the ability of the cigarette franchise to generate a lot of cash. But the growth in that cash flow, the growth in the cash machine will come from reinvesting those monies back into the business. And that's where we were concerned 2 years ago. Yeah, 2 years ago when we sold ITC, that's where our concerns were. I can see what you're getting at, that, at the moment, people are a little scared. They've been frightened by what the Fed is doing. They've been frightened by the war. They've been frightened by China's zero COVID. So out of sheer fright, people are latching on to stocks where they feel a little bit more comfortable about the defensive nature. But in our case, I would like to claim we were never frightened, nor are we ever greedy. And since our job is to stay balanced throughout, we'll take the same view on ITC now as we did 2 years ago, until we see more proactive reinvestment of ITC's formidable balance sheet, formidable cash war chest. Until we see proactive reinvestment of that, difficult for us to see where we will get that 20-25% growth in the business that we aspire to see. That we aspire to see in all the businesses we take stakes in.
Saurabh, hi there, morning. When we had interacted a few months ago, you said the insanity is not how the new age tech companies have halved, but how they ran up post their listing. Now we're taking a lot of, we're seeing a lot of them being quite cognizant about their overall profitability metrics, sort of taking notice of the factors that had alarmed shareholders in the past. Having read into some of the company's numbers, the kind of commentary that they're giving, does the view change now, or do you continue to believe that it's not been absolutely justifiable the way they moved?
Miller, there's two ways to see the whole situation. One is to say that until they get the next round of funding, it'll be tough for these new age tech companies, whether they're listed or unlisted. That's one way to see it. The other way to see it, the way we would like to see it, Marcellus, is unless you generate cash, unless you make money, right? Unless you put cash flow on the table, it's very, very difficult for conservative, defensive investors like us to invest in you, right? Show us the money, show us the cash flow. It doesn't matter which sector you are in, whether you're 5 years old or 15 years old. Show us that you can generate cash. If you can't generate cash, I'm afraid it's difficult for sensible investors to buy stakes in these companies.
I want to talk about, the recent changes that you've made to your Little Champs portfolio, and we haven't spoken after that. The fact that you exited La Opala. First, let's talk about that. Why the exit? I mean, is this not the long-term or rather longest-term consumption play which is currently underway? Then why the exit?
I mean, look, I think a lot of credit to La Opala. Over the last decade, they've actually built a category. This category, the whole opalware crockery category, didn't exist before, and Ajit Jhanjhanwala and team deserve enormous credit for building a brand new category. The reason we exited was we're seeing a couple of other companies over the last 3 years now, right? It's been an extended period of time. We're seeing a couple of other companies ramp up the competitive intensity pretty aggressively, and it's a small category, right? Unlike, say, Path Labs or paints, which are multi-billion-dollar categories, opalware is still a small category. And in a small category, we're seeing two other companies with plenty of cash generative businesses. The two other companies who are ramping up the competitive intensity are cash generative businesses. And as we've been doing channel checks pretty consistently over the last couple of years, we've been left a little concerned about, can La Opala respond to the ramp up in competitive intensity? There's no reason that they can't. It's a well-run company. I think, as I said, Ajit Jhunjhunwala does a wonderful job, but we didn't quite see the competitive response, and hence the exit. So as I stress again, if we see Laopala, much like the ITC point, if we see Laopala stepping up to the plate and dealing with the ramp in competitive intensity, we'll obviously revisit that exit.
Then why Homefirst Finance, Saurabh? I mean, I understand that realty is on the anvil of this, multi-year bull run, and, along with realty, the ancillaries as well are going to do well. But given that Homefirst Finance caters mostly to the salaried segment, the fact that, inflation, high interest rates, what have you, are all going to have a bearing. So, I mean, why this one out of the entire basket?
Sure. So we already have Aavas. We added Homefirst in several of our portfolios. Why did we add Homefirst? Logic is threefold. Firstly, we're continuing to see spectacular numbers in terms of formal sector job additions. So if you take the EPFO numbers, I think for the last 3 years or something like 30 to 35 million jobs created in the formal sector. I've never seen that sort of remarkable job creation in the formal sector. I haven't seen it in any country, let alone see it in India. Just to put it in perspective, 30 million jobs, that's the entire French labor force. That's the entire British labor force. That's what we have added. And even the recent EPFO prints on formal sector job creation stay very strong. The natural flow through of that will be mortgages, right? There will be home loans. It's a visceral human desire to have a roof over your head of your own. So that's the first piece, that there's a big story around formal job creation. This is the formalization of the country. It's showing up in job numbers. Second leg is the HDFC banks and Kotak banks in our portfolio focus on sort of lending to the people who are watching this, people like you and me, right? At the 10 lakh end, of the home loan market, we don't see the high street banks being as visible, as relevant. And at that 10 lakh end, we're very keen to participate, because I think a lot of the formal job creation is not big ticket, incredibly well paid jobs. It's modest paying jobs, 2, 3, 4, 5 lakh per annum salary jobs. And that's where Aavas and Homefirst are very good. Aavas does it more for the non-salaried class. In our office, we say for the Golgappa seller, Aavas provides a 10 lakh house, and Homefirst does it more for the salaried class. So say a sweeper working for a state government, earning say 3 lakhs a year, Homefirst will give them a home loan. We see this space as very vibrant, with lots of growth prospects. And these two players, both of them, Aavas and Homefirst, have clean accounts, good corporate governance, have shown strong ability to deal with loan losses through COVID, well-capitalized balance sheets, and hence the Marcellus load up on both of these names.
Apart from the heavyweight FMCG names and the likes of Nestle, Asian Paints, you had also spoken about Pharma Ancillaries and FMCG Ancillaries seeing a little bit of consolidation, and some stocks that you'd flagged off, Sharda Crop, Galaxy, Fine Organics. Any more additions, and are you looking at this space closely?
So just to sort of clarify, we are shareholders in Galaxy and in Fine Organics. We don't hold Sharda Cropchem. We have never held Sharda. In terms of what's happening in this space, in terms of pharma ancillaries and FMCG ancillaries, we continue to be very constructive. We are seeing good results coming through. So, for example, I think Fine Organics published results last week. Top line, bottom line, both growing at a very healthy rate. As I might have said before, its grip on the food additive space, on emulsifiers, is very strong. It's one of the most dominant players in food additives in India. Similarly, say a smaller FMCG player like Amritanjan. We've been shareholders for 3 years now. Solid results, nothing spectacular, but solid results from a small FMCG player like Amritanjan. Galaxy too, I think, is dealing with the input cost pressures. Naturally, if you're making surfactants, you end up coming under input cost pressures because of the petrochemicals issue. But very impressed by how Galaxy is protecting its gross margins in these difficult times. So both pharma and FMCG ancillaries, we will stay invested. That's a straightforward play to play the formalization of the entire B2B ecosystem in our country.
Saurabh, always good having you on the show. Thanks as always for joining in.
Thanks a lot.